Today, we're diving into something we all dream of, building wealth, and more importantly, keeping it for the long haul. It's one thing to grow your money, but sustaining it takes skill, strategy, and the right mindset. Imagine having the financial freedom to live your life on your own terms. In today's video, I'll walk you through the most powerful steps you need to know to not only build but also maintain your wealth. If that sounds exciting, hit the subscribe button and turn on notifications so you never miss out on our latest videos about creating a better financial future for yourself. Your support means so much to us, and by subscribing, you're helping us reach even more people with these valuable tips. Let's get started. Building wealth starts with the right mindset. Wealthy individuals think differently about money, risk, and opportunity than those who struggle financially. Before discussing practical strategies, let's explore some key psychological principles that will shape your financial future. A growth mindset is the belief that your abilities, intelligence, and talents can be developed through hard work, learning, and persistence. This concept also applies to financial success. Building wealth is a long-term process, and it requires you to continually learn and improve your financial strategies. People with a growth mindset view financial challenges as opportunities to grow, whereas those with a fixed mindset often see failures as insurmountable obstacles. For instance, if an investment doesn't go as planned, someone with a fixed mindset might give up and declare that they're just bad with money. But someone with a growth mindset will study what went wrong, learn from their mistakes, and make smarter decisions in the future. One of the core principles of wealth building is learning to delay gratification. This means resisting the temptation to spend your money on immediate pleasures and instead focusing on long-term financial stability. Wealthy individuals prioritize investing over spending. Instead of buying a new car or taking an expensive vacation, they might invest that money into assets like stocks or real estate that will generate income over time. Delayed gratification is essential because it shifts your mindset from short-term pleasure to long-term gain. One study conducted by Stanford in the 1970s, known as the marshmallow test, showed that children who could delay gratification, wait to eat a marshmallow in exchange for a greater reward later, were more successful in various areas of life, including finances, later on. Success doesn't come from large, one-time efforts, but from consistent small actions repeated over time. In the same way, building wealth requires adopting positive financial habits. These include budgeting, keeping track of your income and expenses to ensure that you are living within your means. Consistent saving, automating savings each month so that a portion of your income goes toward future investments or an emergency fund. And of course, financial education. Continuously learning about personal finance, whether through books, courses, or podcasts. People who become wealthy don't just get lucky. They have habits that ensure they live below their means and grow their money consistently. One of the key principles of wealth building is creating multiple streams of income. Relying on just one source of income, like your job, puts you at risk if that income stream dries up. Let's discuss some of the most effective ways to diversify your income and create lasting financial security. Active income versus passive income. Active income is the money you earn by trading your time for money, such as working a 9-to-5 job, freelancing, or running a business. Active income is limited by the amount of time you can work. It's crucial to start by establishing a reliable active income stream, as this will fund your investments and create the foundation for building wealth. Passive income, on the other hand, is money that you earn without needing to trade your time for it. Passive income might require upfront investment or work, but once it's established, it requires little to no ongoing effort. Examples of passive income include rental income, dividends from stocks, royalties from creative works, and affiliate marketing. Passive income is essential because it continues to grow your wealth even when you're not actively working. For example, consider someone who invests in a rental property. While they may need to invest time in managing the property or hiring a property manager initially, the rent collected each month can become a steady source of passive income. Investment portfolios are one of the most powerful ways to generate passive income and grow your wealth. A well-diversified portfolio consists of different types of investments, such as stocks. Investing in stocks allows you to become a partial owner of a company. Over time, if the company grows and becomes more profitable, so will your investment. Bonds. These are essentially loans you give to companies or governments in exchange for regular interest payments. Real estate owning property can provide rental income as well as appreciation over time. Mutual funds, or ETFs. These are collections of stocks or bonds that are professionally managed and offer instant diversification. Investing in a variety of assets reduces your risk. If one investment doesn't perform well, others in your portfolio may offset those losses. In today's digital age, it's easier than ever to create a side hustle that generates additional income. A side hustle can be anything from freelancing in your area of expertise, selling products online, creating digital content, or offering consulting services. Many people who have built wealth started with a side hustle that eventually became a full-time business. For instance, you could start a blog or YouTube channel about a topic you're passionate about. Over time, as your audience grows, you can monetize your content through ads, sponsorships, or product sales. The beauty of side hustles is that they allow you to make extra income without quitting your day job, giving you more security as you build your wealth. Building wealth isn't just about how much you make, but how much you save and invest. Many people focus on earning more money without considering how to manage the money they already have. Here are key strategies to help you save and invest wisely. One of the easiest ways to ensure you're consistently saving is to automate the process. Set up automatic transfers from your checking account to your savings or investment account as soon as you receive your paycheck. This pay-yourself-first strategy ensures that saving becomes a priority, not an afterthought. You're essentially forcing yourself to live on less, which promotes frugality and responsible spending. Automating savings also helps you avoid the temptation of spending money on non-essential items. Many successful people swear by this method because it takes the decision-making process out of the equation. Savings happen without effort. Before investing aggressively, it's essential to have an emergency fund in place. Life is unpredictable, and an emergency fund acts as a financial buffer in case of unexpected events, such as medical bills, car repairs, or a sudden job loss. The general recommendation is to save at least 3 to 6 months of living expenses in a liquid, easily accessible account. For example, if your monthly expenses are $3,000, your emergency fund should range from $9,000 to $18,000. Having this fund ensures that you don't have to go into debt or sell off investments in case of emergencies. Albert Einstein once called compound interest the eighth wonder of the world. Compound interest is when the interest you earn on your investments starts to earn interest itself. Over time, this can result in exponential growth of your money. Let's say you invest $10,000 at a 7% annual return. After 1 year, you'll have $10,700. The next year, you'll earn interest not just on your original $10,000, but also on the $700 in interest you earned. This cycle repeats, and over decades, it can lead to substantial wealth. The key to benefiting from compound interest is to start as early as possible and remain consistent in your investments. Even if you can only invest a small amount each month, the earlier you start, the more time your money has to grow. A significant part of wealth building is not just earning more money, but also being smart about how you spend it. Controlling your expenses and living below your means is a critical aspect of maintaining long-term financial success. It's impossible to manage your finances effectively if you don't know where your money is going. Tracking every expense, no matter how small, is essential for understanding your spending habits. You might be surprised to find that a significant portion of your income is being spent on things you don't need or value. There are numerous apps and tools available today that make expense tracking simple. Apps like Mint or YNAB, which stands for You Need a Budget, categorize your spending and help you identify areas where you can cut back. Wealthy individuals are meticulous about tracking their expenses because they know that small leaks in their budget can lead to significant financial losses over time. Living below your means is one of the most effective ways to build and sustain wealth. This doesn't mean depriving yourself of things you enjoy. It simply means being mindful of your spending and making sure your lifestyle doesn't outpace your income. Many people fall into the trap of lifestyle inflation, where they start spending more as they earn more. But the wealthy tend to keep their spending in check, even as their income grows. For example, Warren Buffett, one of the richest people in the world, still lives in the house he bought in 1958 for $31,500. While he certainly could afford a much larger and more expensive home, he's chosen to live modestly, which has allowed him to accumulate more wealth. 3. Cut unnecessary expenses. The more you can reduce unnecessary expenses, the more money you'll have available to save and invest. This doesn't mean you need to live a Spartan life, but rather that you should be conscious of where your money is going. For instance, many people pay for subscription services they don't use or eat out frequently when they could cook at home. By cutting back on discretionary spending, you can significantly increase your savings rate. Over time, these small savings add up and can be reinvested to grow your wealth. Scene 6. Learn to manage debt wisely. Debt can be either a tool for growth or a burden that holds you back. Learning to manage debt effectively is crucial to both building and sustaining wealth. 1. Good debt versus bad debt. Not all debt is bad. Good debt is debt that helps you acquire assets that appreciate in value or generate income. For example, a mortgage on a rental property can be considered good debt if the property generates rental income and appreciates in value over time. Similarly, taking out a loan to invest in a profitable business can be considered good debt. On the other hand, bad debt is debt that is used to buy depreciating assets or things that don't generate income. Credit card debt, payday loans, and car loans often fall into this category. These types of debt tend to come with high interest rates and can quickly spiral out of control if not managed properly. The key is to minimize bad debt and use good debt strategically to grow your wealth. Avoid high-interest debt. High-interest debt, particularly from credit cards, is one of the biggest obstacles to building wealth. Interest rates on credit card debt can be as high as 20% or more, which means that your debt can grow rapidly if you only make minimum payments. To avoid getting trapped in a cycle of debt, it's essential to pay off high-interest debt as quickly as possible. If you have multiple forms of debt, one strategy is the debt avalanche method, where you prioritize paying off the highest interest debts first while continuing to make minimum payments on the others. This approach saves you the most money and interest over time. Leverage debt for growth. While it's important to avoid bad debt, there are times when taking on debt can actually help you build wealth. For example, borrowing money to buy real estate that generates rental income can be a smart financial move if the property appreciates and provides positive cash flow. The key to leveraging debt for growth is to ensure that the return on your investment is greater than the cost of the debt. For example, if you take out a loan at a 5% interest rate to invest in a business that generates a 10% return, you're effectively making a 5% profit. Build a long-term plan and stay committed. Sustaining wealth requires a clear long-term strategy. Building wealth doesn't happen overnight, and maintaining it requires ongoing dedication and discipline. Set clear financial goals. Setting specific, measurable, achievable, relevant, and time-bound or SMART financial goals is essential to staying on track. Whether your goal is to save for a down payment on a house, pay off debt, or retire early, having a clear objective gives you direction and motivation. For example, if your goal is to save $50,000 for a down payment on a home in the next 5 years, you can break that goal down into smaller monthly or yearly targets. This makes the goal more manageable and helps you stay focused on your long-term plan. Reinvest profits. Once you start seeing returns on your investments or business ventures, it might be tempting to spend that money. However, reinvesting a portion of your profits can significantly accelerate your wealth-building process. Whether you're reinvesting into stocks, real estate, or expanding your business, this is how you compound your wealth. For example, if you invest in stocks that pay dividends, you can reinvest those dividends to buy more shares, which will, in turn, generate even more dividends. Over time, this reinvestment strategy can lead to exponential growth. Stay educated. The financial world is constantly evolving, and strategies that work today might not be as effective in the future. To sustain your wealth, it's essential to stay informed about market trends, investment opportunities, and personal finance strategies. This might involve reading books, attending seminars, or following financial news. For instance, keeping up with changes in tax laws can help you minimize your tax burden and keep more of your hard-earned money. Similarly, staying informed about market trends can help you make better investment decisions and avoid potential risks. Building wealth is only half the battle. Protecting it is just as important. Unexpected events like economic downturns, health issues, or lawsuits can threaten your financial security. Here are some key strategies for protecting your wealth. Diversification is one of the most effective ways to protect your wealth from market volatility. By spreading your investments across different asset classes, like stocks, bonds, real estate, and so forth, you reduce the risk of losing a significant portion of your wealth if one investment performs poorly. For example, if the stock market experiences a downturn, having investments in bonds or real estate can help offset those losses. Diversification ensures that your entire financial future isn't tied to the performance of one asset class. Insurance is another essential tool for protecting your wealth. Whether it's health insurance, life insurance, or property insurance, having the right coverage can protect you from financial ruin in the event of unexpected disasters. For example, health insurance can prevent a medical emergency from wiping out your savings, while property insurance can protect you from the financial consequences of a fire, flood, or other disaster. Estate planning is essential to ensuring that your wealth is passed on to future generations according to your wishes. This might involve creating a will, setting up trusts, or exploring tax-efficient ways to transfer wealth to your heirs. Proper estate planning not only ensures that your wealth is protected after you're gone, but also helps minimize taxes and legal fees, allowing your loved ones to inherit more of your hard-earned money. So there you have it. Building and sustaining wealth is more than just making money. It's about adopting the right mindset, creating multiple streams of income, controlling your expenses, and staying committed to your long-term financial plan. If you found these tips helpful, don't forget to hit the subscribe button and give this video a thumbs up. It really means a lot to us and helps us continue to create valuable content for you. Thank you so much for watching, and we'll see you in the next video.